talking about less than 1% of traders ever reaching a payout, and under 0.4% making it to a second payout. When the statistics are this brutal, there have to be rules to how this game works. That's what I'm going to be walking you through, step by step, what I call the matrix model. Throughout this video, I'll guide you through the exact strategy I used to get multiple payouts, and I'll show you exactly how to use it. The goal of this model has always been to help you think differently from the majority of traders and outperform common retail approaches. If you have been struggling to apply the matrix model correctly, this video can help you in many different ways. What I am going to show you here is a refined version of the matrix model that focuses on precision rather than frequency. This means fewer trades, but higher quality setups. As you can see, this is the matrix model with added precision. Let me explain what elements we are going to use to improve the accuracy of this model. The first and most important improvement, which alone can enhance the model by at least 50% compared to before, is the proper use of directional bias and draw on liquidity. In my previous videos, I explained a simpler approach where we targeted the opposing side of the range with a fixed risk to reward, usually around 1 to 3. While that approach works, in this video I am going to show you how to identify a more reasonable and structured directional bias, along with a logical and realistic draw on liquidity. This allows us to understand not just where price might react, but where it is most likely trying to go. Before we go any further, it is important to set the right expectations. In this video, I am not claiming that this model will always give you extremely large targets, and I am not saying that you will find this setup every single day. The purpose of this model is not to trade frequently, but to trade selectively, with clarity, structure, and confirmation. When used correctly, this refined matrix model helps you stay aligned with market structure, liquidity, and intent, rather than forcing trades or chasing moves. This is what allows the model to perform consistently over time instead of relying on luck or overtrading. First, let me explain what bias and draw on liquidity actually mean. In simple terms, bias is the market narrative. It describes the direction in which the market is most likely willing to move. That direction is either bullish or bearish. Bias is not a prediction based on emotion. It is a logical conclusion drawn from market structure and behavior. Draw on liquidity is closely connected to bias. It refers to the reason behind that directional movement. If your bias is bullish, draw on liquidity answers the question of where price is likely trying to go and why. It identifies the specific areas that price may target as it moves in the direction of your bias. Now that the basic meaning of bias and draw on liquidity is clear, let me explain how you can identify them in a simple and practical way. This process is not complicated, and you do not need to add anything new or advanced to your analysis. You simply need to apply the same logic you already use on lower time frames, but on a higher time frame. On lower time frames, you identify bullish or bearish conditions by observing market structure and price behavior for entries. To find your daily bias, you do the exact same thing, but on a higher time frame. That is all you need to do. When you analyze higher time frame structure in this way, it becomes much easier to determine whether the market is more likely to move bullish or bearish. Once your bias is defined, finding draw on liquidity becomes straightforward. You simply mark out the most recent range that aligns with your bias. If your bias is bullish, you focus on the most recent bearish range that has not yet been fully swept. Within that range, you then look for any unfilled price delivery arrays in the premium of the range. These can include unfilled order blocks, low resistance liquidity areas, equal highs, or equal lows. Any unswept or unfilled liquidity in that area can serve as a valid draw on liquidity. That is all you need to do. There is no need to overcomplicate this process. If you follow these steps consistently, this approach will give you a correct and usable bias and draw on liquidity most of the time. In my experience, this method provides a clear and accurate bias and draw on liquidity alignment in roughly 80% of cases, which is more than enough to build a consistent and repeatable trading framework. The next concept I want to explain is the point of interest. A point of interest is simply the area within a range where you plan to execute a trade. It is the location from which you expect to see liquidity sweeps and a reaction in price. Instead of entering randomly, the point of interest gives you a specific zone where you are prepared to look for confirmations and execute your setup. Finding a point of interest is very simple and does not need to be complicated. The first step is to mark out the range in which price is currently moving. Once that range is defined, the point of interest is selected based on your directional bias. If your bias is bullish, you should focus on discounted price delivery arrays within the bullish leg of the move. It is important to understand that when your bias is bullish, you should always use a bullish range to define your point of interest. This ensures that you are trading in alignment with the higher time frame structure rather than against it. There are also simpler and more straightforward ways to identify points of interest if you find this approach difficult at first. Previous swing highs and swing lows are valid points of interest. In addition, previous day highs and lows, as well as previous session highs and lows, are also commonly used and effective points of interest. These levels often contain liquidity and attract price reactions, making them reliable areas to observe for trade setups. So if the first method feels complex, you can start by using these more obvious levels. Over time, as your understanding improves, you can combine both approaches to identify higher quality points of interest with greater precision. The next concept I'm going to explain is the most important part of the matrix model. Most of you already know what I am referring to here. I am talking about the manipulation that occurs on the 15-minute time frame after a liquidity sweep. This step is critical to the entire model, and without it, the setup is not considered valid. To explain this clearly, let us assume that price has just taken sell-side liquidity. After this liquidity sweep occurs, the next step is to focus on the candle that performed the sweep. Specifically, we mark the low of that candle, not the candle body, but the wick low, which is the lowest point of the sweep candle. Once that low is marked, we do not enter immediately. Instead, we wait for a subsequent candle to take that same low and then close back inside the wick of the original sweep candle. This action is what confirms the manipulation and indicates that liquidity has been taken and rejected. If this explanation feels unclear right now, do not worry. I will show this process clearly on the charts later so you can see exactly how it looks in real market conditions. Once you see it visually, the concept becomes very easy to understand. This is the third step of the matrix model, and it is the most important one. Without this confirmation, I would not consider any setup to be a valid matrix model trade. This manipulation and rejection after the liquidity sweep is the core of the model and the main reason it works consistently when applied with discipline. The next concept I want to discuss is also very important for achieving higher precision and a better win rate. When it comes to execution, there are many entry models that you can use. You can use market structure shifts, inverse fair value gaps, order blocks, or any other confirmation that fits your trading style. All of these methods can work if they are applied correctly. However, in this video, I am going to focus on using breaker blocks as the primary entry price delivery array. The reason for this is that breaker blocks provide a higher level of confirmation compared to many other entry models. They often represent a clear shift in order flow and offer more reliable entries when used in the right context. In this video, I will show you exactly how to use breaker blocks within the matrix model to improve both win rate and precision. By combining breaker blocks with the earlier steps of the model, such as bias, draw on liquidity, point of interest, and manipulation confirmation, the overall quality of the setup improves significantly. That covers the explanation for now. With the concepts clearly defined, let us move on to the charts and break everything down step by step in real market conditions. First of all, the two things we need to identify are our directional bias and our draw on liquidity. To determine our bias, we start by observing market structure on the 15-minute time frame. As you can see, we have a clear market structure shift on the 15-minute chart, which tells us that our bias is bullish. Once our bias is defined, the next step is to mark out the relevant range. After marking this range, we check whether there are any unfilled price delivery arrays below the discount level. In this case, we can clearly see an unfilled fair value gap located in the discounted area of the range, which becomes a valid area of interest. After that, we focus on identifying our draw on liquidity. Looking to the left side of the chart, we examine whether there are any logical liquidity targets. By marking the premium and discount of the range, we can see if there is anything at or above the discount that price may be drawn toward. Here, we can see an unfilled order block that aligns with our bullish bias. When we move down to a lower time frame, we can also observe equal highs, which provide additional liquidity targets. Next, we wait for price to interact with our discounted unfilled fair value gap. As you can see, price sweeps sell-side liquidity into this area. At this point, we do not enter yet. What we want next is confirmation in the form of manipulation. Specifically, we wait for the next 15-minute candle to take the low of the sweep candle and then close back inside that low. As you can see here, price takes the low of the sweep candle and closes inside it. This candle becomes our manipulation candle, and this step is the most important part of the matrix model. Once the manipulation is confirmed, we then shift down to the 1-minute time frame to look for entry confirmation. On the 1-minute chart, we can see the formation of a breaker block. This breaker block serves as our entry model, providing higher precision and a higher probability setup. After placing the entry at the breaker block, setting the stop loss below the relevant low, and targeting our draw on liquidity, you can see how cleanly price moves toward the target. The move is direct and efficient, reaching the draw on liquidity without unnecessary retracements. This is the complete manipulation-based matrix model with higher precision. By combining bias, draw on liquidity, manipulation confirmation, and breaker block entries, the model becomes structured, repeatable, and highly effective when executed with discipline. That's it for this video. If this helped you, make sure to like the video and subscribe to the channel. If you want to join my mentorship program, the link is in the description. And for any questions or doubts, you can join my Discord. I'll see you in the next one.